Those of you who have watched our webcast before will be very familiar with Michael Hughes, who is our investment analyst and also, in effect, our economist. So it's a really delightful opportunity to have another chance to talk to you and to discuss what's happened in the past 12 months and to look ahead into 2018. We know that the portfolios have all performed pretty well and certainly very well against their benchmarks. But how do you assess their performance in more critical terms, shall we say?
Well, if we look at the market scene, there were some things that we were able to prepare for. Perhaps inflation coming back was the greatest macroeconomic development. And we've gone in the UK from having no inflation 2.5 years ago to having inflation that's above the government's target and hence started to see interest rates rise. But we hadn't been able to see that coming quite easily, and so we had reduced our exposure to bonds that obviously get affected by interest rate changes. A pleasant surprise to some degree is that the momentum of economic growth was pretty good, especially in the emerging areas. So concerns that we'd seen in the markets about China were not actually delivered. And even in places like India, which had some big macro changes at the beginning of the year, they seem to have recovered relatively quickly from those. So by and large, the emerging market story had been well rewarded in terms of investment returns, and the economic news coming out of the emerging world by and large was good. If there is one negative for 2017, it was very definitely the year where politics overtook economics, and we only have to think of North Korea, the Middle East generally, and in the context of Europe, then Brexit and the Austrian elections, and next year the Italian elections as well. So there's still a lot of political risk within the European framework, and as indeed there is in other parts of the world.
You mustn't forget Mr. Trump in that either as well.
No, indeed, Mr. Trump, it could never be forgotten for long. But if you think of those political developments, one of the consequences was that the dollar did begin to weaken. And that is actually good news for emerging currencies by and large, but it comes after several years where the dollar had been quite strong. So that was a development that, again, I think we were ready for, but it was one that was a very significant development in terms of financial markets.
So in terms of how the portfolios have performed over that period of time, they were broadly in line with our sort of expectations at the beginning of the year?
Yes, if anything, I think the returns were slightly better, partly because the economic news was better for longer, especially in emerging areas, but not exclusively. And one of our fears for 2018 and 19 was that we would get some degree of economic slowdown, which I think we're still going to have, but that didn't materialise quite as quickly in 2017. And that obviously helped the UK market particularly.
Okay, you've already touched on sort of next year. We're on the cusp of the new year, so it's the opportunity to look ahead. So what are the themes? What are the events that, in terms of how we manage the portfolios going forward, that you're going to be bringing to our attention, that you're going to be talking about particularly?
Well, I think we are going to see more risk attached to the UK markets, partly because of the politics, but also because of the slowdown in the economy, which is now being forecast quite widely. And part of that is to do with the Brexit uncertainty, but equally it's the fact that we've had a fairly lengthy cycle. We've seen inflation pick up, we've seen monetary policy change. Now, although we haven't seen much of an interest rate rise yet, remember we have seen a 5% appreciation of the currency since the summer, and that counts as monetary tightening. It's almost equivalent to a 1% increase in interest rates. So you could argue that we've started to see some degree of money tightening, and that obviously will have an impact on the housing market and on activity generally going into next year. So the UK we are a little concerned about. The two areas of particular interest though, not necessarily just for 1 year, are Japan and indeed Asia more widely. Japan because of the reforms that we have seen come through, and the fact that the Japanese companies now have an absolutely enormous cash surplus. The cash that they've built up is virtually equivalent to 2/3 of the size of the Japanese economy. And the Japanese government is very keen for them to start using this, either in terms of increasing the wages of their employees, or paying shareholders more dividends, or indeed investing it. If they don't do that, there's a risk that the Japanese will do what the Koreans and the Taiwanese did when they were faced with a similar problem, and they put a tax on companies' excessive cash surpluses. Now, I don't see the Japanese doing that. I think it's much more of a moral suasion to get companies to respond. But I do see these companies responding. Japan historically has invested quite heavily overseas, so it may just be that part of the investment of these funds goes overseas, but it still influences and benefits shareholders in Japanese companies. So we have taken already to put quite a big position in Japan in portfolios, and depending on the risk profile of clients, between a third and a quarter of their total global equity exposure is now devoted to Japan, because after 20 years of going nowhere, it's now looking as if it's about to turn a corner. And then more widely, if we look at the Asian story, people have thought of Asia as being very much the copiers and the manufacturers. Actually, what they are now are the inventors. A lot of the new exciting companies, global companies, are coming out of China and out of Asia generally, and also out of India. And these are companies that are innovating and investing very effectively. And nearly a half of all global patents last year came out of emerging companies, mainly Asian ones. So I think that the perspective at a company level on Asia is quite interesting. So we have looked at funds that have chosen some interesting Asian companies that we think will be global players in the world in the years to come. So not necessarily a story for 2018, but a story for the next 5 years or so. So Asia and emerging generally continue to feature quite highly in our portfolios, but we are making that investment by reducing our exposure to the UK. So there's more of a bias away from the UK than in the UK.
Well, it's been talked for a long time, hasn't there, the fact that Asia, where you're talking about, principally, younger population, they're consumers, they're also productive, etc.
Yes.
So this is really a sort of a continuation, or is this almost seems like an uptick, if you like, in that story, which has been running for a little while?
Well, one of the Asian themes we have been playing really for years, actually, is the growth of the middle class in Asia, as you start to see wages and living standards increase. And on the back of that, obviously, their spending power and what they spend on changes. That's already been incorporated into the portfolios, and they've reflected quite well on that. What we're now looking at is the innovation that you're going to see in Asia, where companies are going to be introducing new products, new services, new approaches to business that will end up being global players. And these are the companies of the future, if you like. Whereas a few years ago you'd have thought of it being the Americans or indeed the Europeans doing that, I think you're going to hear a lot more of some of these Asian companies.
So where does all this leave the old established economies? You know, if we're talking about, well, you could say Japan is not really established, but sort of, part way. But in terms of the States, in terms of Europe, in terms of the UK, we know that within the portfolios, we've always had an emerging market bias.
Yes. And
we have been pretty much underweight, certainly in the UK, probably also in terms of Europe as well. So that's really reflecting our take on the comparative upside or upside potential, in a sense, between those two different blocks. So are the established economies sort of losing ground in a sense?
Well, I think the stock market can be a different animal to the economy. And the stock market contains companies that they may be based in Europe or based in the States, but actually are global companies. So what we've tried to do is choose those funds that have the global winners, be they European or American. It doesn't really matter what their country of origin is. Whereas when it comes to the geographical exposure, that's much more relevant for the mid-cap or the small stocks. And by and large, we have felt more comfortable about some of the small cap exposures in Europe particularly, than we have some of the larger cap ones. But these are looking at the domestic players. But I think the story of the future is that we are looking at a new corporate leadership in terms of those companies that are going to be coming through quite strongly. And as we have seen in the last 2 or 3 years, there are 5 companies, mainly American, but not exclusively, where the market capitalization has really grown, and these 5 companies now account for this same market capitalization as the entire UK market. So it gives you a sense that getting the right companies in the portfolio matters more than necessarily a geographical bias.
Just the last question. We've had a bull market, or a version of a bull market, for quite a long time now, and in historical terms, it is a long time. People are getting a little bit concerned sometimes about, you know, where does this all end? You know, our views about you know, that aspect of risk, if you like, and what we've been doing within the portfolios.
Well, the thing that we tried to do last year, and to some degree will continue doing, is moving away from financial assets to real assets. So taking some of the equity exposure, the stock market exposure, down in favour of things like private equity, infrastructure, property, commodities. That has been put into the portfolios in 2017. Going into 18 and possibly even into 19, where we see higher interest rates coming through, the end of quantitative easing in all the developed economies that have had it, and by the middle of 2019, on the current policies, there won't be any quantitative easing. So markets will begin to discount that. I think it's as well to have a slightly lower risk profile for equities than we've had in the past. We have taken the exposure to bonds already down. That was a year or 2 ago. I suspect we'll be taking more of the equity exposure down in favour of more defensive areas and indeed more real assets.
Okay. Michael, thank you once again for your time and your insight into markets now and looking over the hill. Thank you very much.